The reason most of the startups fail is that we build something and we think there is a huge market for it or people really need it, but they may not pay for it. So achieving product market fit is the biggest problem for early stage startups.
Welcome to a new wave of entrepreneurship by Venture for Canada. Venture for Canada is a national charity on a mission to foster the entrepreneurial skills and mindsets of young Canadians. Our vision is a Canada where young people can equitably realize their entrepreneurial potential to help build one of the most prosperous entrepreneurial ecosystems in the world.
Welcome to a new wave of entrepreneurship. And on today's episode, I am very excited to explore the theme with our guests of how to raise money before having traction, which is a challenge that so many different startup entrepreneurs face. And our guest today is Mehrsa Raeiszadeh, who is the co-founder of MintList and a startup consultant. Mehrsa, can you describe the traction versus resources challenge for startups, and why is it such a common problem?
Absolutely. And hi, thanks for having me. The dilemma of traction, how to solve the traction versus money and resources is a very common parallel dependencies that startup founders face. So the way it works is that you want to have traction, but you need money and resources. You need to pay a team. You need to build a product or your MVP and try to get traction. And then for getting that money or getting the resources, you need traction. So it's the chicken and egg problem.
Awesome. Can you talk a little bit for our listeners about describing your own personal experience with this problem? And in answering the question, it would be great for you to describe a little bit of your own startup journey, founding and building Mintless.
Sure. So we started building MintList back in 2020. It's a software platform for buying and selling cars, but in a very unique way. It lets you sell your Honda to a Honda dealer, for example, for 30,000 and pick up a Mercedes from a Mercedes dealer for 50,000 and pay the tax on the $20,000 difference. So no one in North America was doing that when we started, but similar like digital platforms um, came to the market that year. And we entered a very busy space while we were working on defining our MVP. We had two competitors in Canada that raised $250 million each. And we're thinking of how to solve this traction versus getting resources to get our product to market. So what we did is we started with building trust with the investors and the people who are going to provide us money. And that was show that the customers would be using that if we build it. But then we face another parallel dependency within that parallel dependency of resources versus traction because we were building a two-sided marketplace, a B2C to B. So we had the parallel dependency of we need dealers to get customers and we need customers to get dealers. So it was another parallel dependency within that parallel dependency. And to solve that, we started with um, the dealers to see if we build this product, would the dealers use it? Because we knew where they were. We had a relationship with the dealers and we wanted to see if we can bring them on board. So what we did is that we put an Envision app together in like a week, just to show like a 4 or 5 pages of how this product would work and what it would do for them if we build it. Then we took it to the dealers and we said a go no go decision. We said, okay, if we can sign up 20 dealers in a month, we'll continue. If not, back to the drawing boards. People are not going to pay for it if we build it. And that's how we had over $1 million in committed ARR, annual recurring revenue, before we wrote this feature code.
Congrats on getting traction so quickly. And I think that story of just having this idea and building something simple and then Envision app quickly is something that should inspire a lot of listeners. In talking with a lot of different startup entrepreneurs and founders, something I often hear is this challenge of prioritization, of knowing how to balance the pressure of needing to raise money from investors, but also the pressure of actually selling and getting customers and finding product market fit. Mehrsa, what advice do you have for listeners on how entrepreneurs can balance these two different things?
That's a fantastic question. I have a lot of startups that reach out and they ask the same question. I always lean towards getting traction. The best money is users' payments. That's the best source of revenue. That's the best source of money is revenue. So I always focus on how do we unlock revenue from the users. So to answer your question specifically, how do we go about that? Is there are different ways we can do it. I give you another example of the way that we did it at MintList. We had $1 million completed ARR before we wrote the Stitcher code. There is another founder that I have in my group is Anne. She's the co-founder of Glookskind, is a smart baby stroller. She had 2,500 pre-orders before she started manufacturing. And then she took a prepayment from the first 130. That was the volume of the first batch of her manufacturing facility. She got prepayments from 130. And then she started manufacturing and released the first batch to 130. And now she's unlocking the rest of the 2,500. So I always focus on the traction. How do we find a way to get customers pre-order, prepay, commit to a revenue, and then use that for building trust and de-risking this for investors, and then get resources that you need to get the product to market and actually unlock those revenues.
That's an excellent example of how to get traction with limited resources. I think pre-orders can be something that um, helps get money in the door for you to build your product before the product even exists, and is non-dilutive in terms of like your equity as well in most cases. What are some other creative strategies for how entrepreneurs can get traction or demonstrate traction for their products at the really early stages?
Um, Different ways that you can show traction. I mean, I answered that question in a different way. The ways that you can show traction to investors before having a product. Um, because we talked about how you can um, show traction from the customers. But what are other ways that you can show traction? Could be mm, emphasizing the expertise of your team. Who do you have on board? Who's doing this and why you? And for an early stage startup, that's super important for the investors because they're investing in us as co-founders of building this and executing on this vision. So that's very important. The other way that we can focus on is by partnerships, and we can expand on that more. I think that's very important. How we can bring industry players, partners on board to show that there are other people that have invested in this. There are other people that are supporting to bring this to the market and have bought into the vision. Another way that comes to mind that worked really well for us was to um, joining accelerators and programs that have rigorous due diligence, like Google for Startups. They only pick like a dozen companies, like a startups, in a year for the category that we play. That the startups, not the female founders or um, minority groups, but for the Google for Startups, they only pick a handful a year, and we're one of those. So that shows that you have been on top of your field for Google to invite you to join their accelerator, or Y Combinator or CDL in Canada. Like we have CDL, fantastic mentors, and you have to go through that process and then all the loops to get um, to the last day. So that's another way that you can show. I've gone through that process. There are other people that have done due diligence on my company, and I've gone through all these hoops to make it to the end.
Those are fantastic examples. And one other thing that comes to mind to me is this line of what matters gets measured. And metrics are something that are so critical for companies of all sizes. But for small companies, what are some of the critical metrics that they should look at and that they should be able to demonstrate to prove to investors and to others that they are actually demonstrating and creating traction?
That's a great question. Because the metrics is the way that you communicate and set the expectation and actually show your ability to execute. It really depends on the stage of the startup. If you have a service or product in the market, then it's based on the customer engagement, the retention, revenue, um, closing ratio, your margins. Um, if it's pre-launch, then the metrics look very different. You can look at like the LOIs that you have, the number of partners that you brought on board, the number of pre-sales that we talked about. For me, the most important thing is how do we set the goals and how do we communicate that? So setting smart goals is key. That most importantly for early stage startups, measurable and attainable. Sometimes we get too excited and we have this financial projections that is going to lead to being a unicorn in a couple of years, and we create all this excitement for the investors as well, and then it doesn't work. So going back to your question of setting the metrics, I think is key to set smart goals and communicate that with the investors regularly. We started with like bi-weekly, and then you can have monthly updates, and you can tell them exactly what you're working towards, and um, show that you're achieving those goals because they're smart goals, they're attainable. I can even share more with you, Scott, about how you solve that parallel dependency of traction versus raising money for investors by setting the goals and communication, regular communication. That's been an effective way for us as well.
Can you zoom a little bit into that? What are some of the tactics that you have in terms of communicating regularly with investors this information?
I love diving deeper into this because I have um, many startups weekly reaching out of, Mehrsa, I don't know any investors. How do I connect with investors? How do I build a relationship with investors? I'm a first-time founder. How do I go about this solving this parallel dependency that we just talked about? Building that trust so I can unlock the resources for my traction. So to answer your question, um, investors are looking for their next thing. They're looking for that successful startup to join their portfolio. Why does it have to be you? Why does it have to be me? So we have to show and earn that. We have to show that we are the startup that they should have in their portfolio next, and build that trust. So how do we do that? We have to build that relationship. When we're talking about setting smart goals and working towards achieving them, we need to make sure they're aligned um, with the investors. So for us, I never had investors in that industry. I'm not from auto industry. My PhD is in micro electromechanical systems. I worked in like life sciences, manufacturing, chemicals, not auto industry. So I went like the way I went about it is that I asked my network and I started looking for different investors. Then I started building trust. I gave myself over a year before we started fundraising. And then I asked them, what do you need to see for you to invest in me, to be part of this journey? And get their advice. And we can get their help in defining and setting those smart goals that are aligned with where we want to go, and then keep them up to date. And the key is to making those investors and those what I call partners part of the journey, part of the process. If the investor is part of the process, they believe in the smart goals that you're setting, and they watch your ability to execute and attain those goals repeatedly, continuously, and you have that feedback loop continuously. Why would they not invest in you? So I'll turn the question around and I say, what do your investors need to see in you to invest? And then ask the question from the investor, get to a position that you can ask the investor, why wouldn't you invest in this? I've done everything.
Yeah. Such great and super tangible advice, I think, for listeners. One thing I'd also love to zoom in on is something you talked about earlier, which is strategic partnerships and how they can help demonstrate traction. What advice do you have for entrepreneurs at the really early stages on how to secure a critical partnership that can help that company gain credibility and get to the next level?
You have all the amazing questions, Scott. Partnerships is really important. Why? Because depending on what you're building and the industry you're in, they can bring customers for you. They can they can help building a strong brand, um, and also for expansion. We leverage partnerships very well at my last startup, MintList. What we did, we used the strategic partners for multiple reasons. One was, again, solving the parallel dependency of capital versus traction. Um, and we used those partnerships for building credibility. They became our traction. So um, one was for building credibility, getting traction. We used those partnerships for getting customers. We use them for expansion, and I explain that a little bit more, and for fueling one side of our marketplace. So let me tell you what we did. Um, we brought on board Advantage Parts. It's a company that sells parts to the dealers. This is strategic partnerships we use. They're in the same industry, but they're not direct competitors to us, right? They're a service provider to our customer. We wanted to have dealers on one side of the marketplace. So what we did is that we partnered with Advantage Parts, and then they became our sales team. So they would go to the dealers because they're going to the dealers every month anyways to sell their products and make sure that their relationship is maintained. So not only they actually brought on board dealers to our platform, they actually um, helped maintain dealers be an active user of our platform, because every month that they would go, they made sure that they are an active user. So they also help with the maintenance of the product. The users being dealers being a active user of our product. One, two, because we brought on board Advantage Parts, that was huge credibility for the dealers to come on board. We use it as a credibility for bringing investors on board, for bringing other partners on board. Also, we brought on board Carfax. Everyone knows Carfax in North America. All the dealers use them. We build the relationships so that would save money for the dealers. Huge credibility for investors, for dealers, for consumers. Also, we build a relationship with Industrial Alliance, one of the major warranty providers in North America. For the first time, they wrote a warranty for consumer cars before being physically inspected. That's huge. If Industrial Alliance is going to do that for an early stage startup that doesn't even have an MVP, guess what? Every dealer is going to say yes. Because you've gone through that due diligence with Industrial Alliance. They're doing this for the first time in North America. Dealers get it, consumers get it, and investors get it. So with these partners, we were able to bring dealers, fuel one side of the marketplace, bring consumers, show the traction to the dealers, even before bringing the consumers, set the valuation, raise funds, go build the MVP, unlock the revenue, bring the customers, and then you have this self-sufficient cycle that's just like feeding itself. And then you manage that.
I love your passion for the idea. You are like a true entrepreneur. I can just tell you love solving problems, and
I absolutely do, especially parallel dependencies.
you're very passionate about it, which I think is amazing. Earlier in the conversation, you talked about your experience with B2B and B2C and kind of navigating both. How do you think that this parallel dependency challenge manifests itself differently with B2B companies versus B2C companies?
Um, um, sure. So B2B, it has longer cycles. It could have longer cycles for close. You may have less um, potential customers in the funnel, but it may take longer for you to close those deals. But the good thing is that you actually know where those customers are. They might be easier to reach. For the B2C, for the business to consumer, for founders who don't know, for B2C, higher numbers of consumers, and really depends on your customer acquisition and effective ways to get your customers. So that looks a little bit different and requires, usually, it can require a lot more marketing dollars because you have to get to all those customers rather than B2B. So each area have their own challenges and advantages.
It's fascinating because you have experience on both sides, especially with your recent startup, where you both had to deal with the B2B challenges as well as like the B2C ones, and how this question of parallel dependencies manifests itself different based on the business model of the company that is involved. We've also talked in this interview about product market fit and ultimately how traction is the most important thing. Like people will invest in the company if the revenues are growing really quickly and it's really like profitable. So traction above all else. What role does product market fit have in demonstrating this traction? And what advice do you have for entrepreneurs on how to try to get to product market fit as quickly as possible?
Getting to product market fit, I think, is the biggest parallel dependencies that customers are like, we startup founders try to solve, because it's again resources versus traction. So I think at the very early stage where our resources might be limited, that's the hardest thing to do. If you pass that hurdle of product market fit, life is more beautiful. So how do we solve that is how we discuss different ways of um, unlocking revenue from your customers. Really get to me for product market fit, staying close to the customer. And the book that I think is very helpful for that is the two books from Amazon, The Amazon Way and Working Backwards. Really working backwards from the customer. What does the customer need? The reason most of the startups fail is that we build something and we think there is a huge market for it or people really need it, but they may not pay for it. So achieving product market fit is the biggest problem for early stage startups. So we talked about how we can look into getting to product market fit from getting customers early on, surveying the customers, but asking the right question, LOIs or contracts for if we can get pre-orders. Also, another way for achieving product market fit is building the MVP. Some people just build the MVP, put it in the market, in a very small market, very targeted audience. They define their early adopter. They're focused in a small area, and then they try to capture that market, get to that repeatable, scalable playbook, and then they go ahead and repeat it to be able to actually show a strong enough product market fit to be able to engage whoever they need to engage to get the resource that they need. It could be hiring amazing team members, it could be investors, it could be government grant providers, partners, customers, whatever it may be.
Such an important advice. And I think it's something that so many different entrepreneurs struggle with is just getting a company off the ground in the first couple of years. It's so tough. Even my context of founding Venture for Canada, I can attest to the fact that the first really 3 years of the organization were pretty brutal. One of the things that a lot of companies face with in the early days is just like cash flow challenges. Of there's never enough money, there's never enough time, and your equity is so super valuable. You don't want to give up ownership of your company at an early stage. You want to try to retain as much ownership for as long as you can. What advice do you have for entrepreneurs on how to access non-dilutive sources of capital? And for listeners, that means sources of capital that fund your business, but doesn't mean you're selling out your equity in the business. So, what advice, Mehrsa, do you have on how entrepreneurs can access non-dilutive capital?
I start with this piece before I answer your question. I love non-dilutives. I think we're blessed to be in Canada that supports startups and getting things off the ground. Um, there are people that think non-dilutives are a distraction and can actually make the startups lazy and delay them facing the reality that there's no product market fit or a strong customer base. I believe that non-dilutives are a blessing from the government for us to be able to take things off the ground, build businesses that generate revenue, and um, create jobs, build something that's our dream. So based on that, I'm on this. I have this philosophy. So let me talk about non-dilutives a little bit. The biggest challenge for non-dilutives, Scott, I think, for founders that specifically the founders that I work with, is realizing that non-dilutive grant providers are a different type of investor. They're investing government's money into a startup. So the way that we need to approach, communicate, and engage these non-dilutive grant providers is just how we would do it with investors. So when I was at MintList, the way we would do it is I had an update that would go to the investors. We talked about SMART goals. Very open and authentically, I would explain exactly where we are, what works, what doesn't work, where are we with as SMART goals. I would do the same thing with my non-dilutive grant providers. For example, for IRAP, my ITA gave us money after 1 year. And he said, Mehrsa was the only person who kept me updated on everything and anything that was going on in her startup. I felt I CT scanned her business before I invested. He knew everything about my business. He knew exactly where we're going and what we had done. So that is very important. Whatever I said about investors, we can replicate that for non-dilutive grant providers. The other thing is we can engage them early on and really understand what it takes to have them join our journey, just same way that we do it with investors. Really need to understand that philosophy. This grant provider, what this government grant, what are they looking for? What is their philosophy? What is their mission? What are they investing money in as startups? So we can work backwards. Again, the Amazon book, working backwards from that, and then build upon it. Have consistent communication, build a reputation, build a credibility and relationship, and then go back and say, hey, could you please help me with this?
I love that advice about treating non-dilutive investors like you would a venture investor. And I also think of that famous line, people invest in lines, not dots. It's important to keep people updated over time. And that's really what will motivate somebody long term to invest in you. There might be some people who just invest after one meeting, but most people, whether they're a non-dilutive investor, a venture investor, or an angel, are going to make an investment after many kinds of interactions over time. And it means keeping people updated. Mehrsa, to kind of wrap things up, what advice do you have in general for entrepreneurs or founders who are dealing with this parallel dependency challenge and really struggling on how to both build a business but also raise capital at the same time?
To wrap things up, and maybe I should have started with that. For solving a parallel dependency, we need to introduce a new parameter. So to break that parallel dependency, to identifying what that parameter is, I do a root cause analysis to understand why there is a parallel dependency between those two parameters. To then identify what is an effective parameter that I can introduce to this parallel dependency to make it an effective loop, a self-sustainable loop. And that's what I've been doing. Like, for example, that's what we did at MintList. We raised 6 million dilutive and 4 million non-dilutive in 2 years. But it was all about adding that additional parameter and making that self-sustainable, the self-sustainable cycle. So one thing I leave your audience with is to get help. there might be someone else who's done it before. Like I brought on board Milan Gaverka. He's a startup mentor and advisor, and he helped us design this system that gets us to $1 million committed ARR. And 3 years later, I'm consulting startups on how to raise like non-dilutives and dilutives and break this parallel dependency. So get help. There are amazing people in this community that are willing to help, and there's someone else who helped them, and they're willing to help the next person.
There's no need to do it alone. I think a lot of entrepreneurs can sometimes be lone wolves, and there's so much expertise that can be tapped into by engaging other people. And intractable problems are not ever really intractable. There's always some kind of way to figure out how to get something done, even though it might seem really daunting when you're first building a business and organization. As we went through this interview, I reflected, even though I founded a not-for-profit, I had those challenges that you were talking about, Mehrsa, where when the first program we launched, the fellowship program, was just getting off the ground, people would say, well, oh, you don't have this program. Why would I invest? It doesn't exist yet. And then, so you make it work with the limited resources you have, and then you have a successful program and people start to invest in it. And even right now, Venture for Canada, we're launching an entrepreneurship through acquisition academy. And I have the same experiences where people are like, well, it doesn't exist yet. So it's like, okay, we get it going. We have a landing page. We demonstrate the traction from interest, and then every like couple weeks, every month, then a little bit more progress, so a little bit more traction, you can get some more people on board. So I learned a lot from this conversation as well. Mehrsa, thank you so much for coming on the podcast today.
Thank you so much for having me. And if anyone needs help, reach out.
Thanks for listening to this episode of A New Wave of Entrepreneurship. Stay connected with us via our socials and through our email list. And be sure to subscribe to us in your favorite podcast app so you don't miss our next episode. Have feedback on today's episode? Let us know directly in the app. Thanks again for listening and for joining the new wave of entrepreneurs. Till next time.